Good evening, good morning, good afternoon, depending on when and where you listen to this call from. Nicholas Cunty here again, representing King Visions Forex. And today we're going to dive into market sentiment. So we're going to actually cover what is market sentiment, understanding market sentiment, risk on, risk off, and we're going to take a look into the commodity currencies. Let me get this PowerPoint pulled up. So without further ado, we're going to look at market sentiment, aka risk on or risk off. Now, you guys may be wondering what actually is market sentiment. Well, quick introduction, market sentiment is actually going to refer to the overall attitude or mood of investors in a particular asset or security. Now, it will be the feeling or the tone of the market. It's also we consider it or look at it as the crowd psychology. It's going to be revealed through the activity or price movement of that security or asset in the market. In broader terms, it's going to be rising prices indicating bullish market sentiment, while falling prices will indicate bearish market sentiment. Now, key takeaways from today's lecture will be market sentiment refers to the overall consensus about a stock or stock market or currency, asset, or commodity. Now, market sentiment is bullish when the prices are rising. Market sentiment is bearish when the prices are falling. Technical analysis can help investors measure the market sentiment, as well as some economic or fundamental approaches as well. So we'll get to this next slide. So sentiment, aka investors' mood. We're going to look at what is risk on, what is risk off, some of the commodity currencies. Now with risk on, you guys will hear me say this: risk on, risk off, wash on, wash off. So risk on is going to refer to the market sentiment when investors are comfortable with taking risk, aka risk on. Now risk on is investment status, which market participants buy riskier assets typically due to improved corporate profits, positive economic outlook, and accommodative central bank policies. So, the raising of interest rates, QE, a couple of different things that we can talk about that will be accommodative central bank policies. Now, in addition, lowered rates, higher yielding bonds or debt are considered risk on, as well as emerging markets, also known as exotics. Now, as these type of assets are purchased, defense assets such as gold and bonds are sold. The result is a risk-on sentiment. The result of a risk-on sentiment is a rise in the stock market and a rise in these higher yielding currencies, which we'll speak about here in a few moments. Now, as a result, the carry trade strategy works well, which we're going to cover in another portion of this course. Now, in closing, commodity prices often benefits during times of risk on sentiment as the market expects strong future economic growth. So we'll also speak about the commodity currencies. Diving into risk off. Risk off is the complete opposite of risk on. Participants change positions to take less risk, typically the effect of downgrading earnings, slow economic growth, and unpredictable central bank policy. So we're basically talking about the opposite of risk on. Everybody else is pulling back a little bit, protecting their capital, moving into safer assets. Now, for an example, uncertainty concerning furthering Fed rate tightening, or interest rates going up. Wall Street actually bet retail traders. An example will be the Wall Street bets retail traders causing the liquidity issue and the ongoing vaccine deployment issue. So this is in current time today. We seen the increase of options trading with Wall Street bets actually caused some liquidity issues, and some of the hedge funds and banks had to move portfolios to kind of cover some of those trades. So equities or the stock market tend to yield a greater return than bonds. Therefore, investors pull their money out of assets by selling their shares of riskier instruments like high yielding currencies. Now, in this situation, the typical investor transferred their capital from stocks to government bonds. This would also be known as risk off status. we're going to take a quick look into the risk on currencies. This will be a great place for you guys to pull out your pen and pencil and jot down some of these currencies. So a risk on or high yielding currency will be the Australian dollar, the New Zealand dollar, and the Canadian dollar. Now, the US dollar generally trades lower against most of these currencies, particular commodity currencies, in a risk on mood. Now, commodity currencies will have a high demand for raw materials from growing economies such as China. This will generally increase the value of the stock market and higher yielding currencies such as the AUD and the NZD. Down below, we do have the couple of commodity currencies, which will be oil and copper. We have them on this risk on slide due to them kind of moving in unison. So if we notice, higher yielding currencies going up, we're typically going to see commodity currencies going up as well. Look at risk off. So risk off currencies are otherwise known as safe havens, are going to be the US dollar, the Japanese yen, and the Swiss franc. Now, countries tied with strong economics are considered safer places to store capital in times of economic uncertainty, since they are less likely to undergo devaluation on a big scale. Keyword on a big scale, amid further market turbulence. So, just to touch on market sentiment, understanding the market sentiment, investors is also known as investor sentiment. It's not always based on fundamentals. Day traders and technical analysis rely on market sentiment as it influences technical indicators that we'll utilize to measure and profit from short-term price movements. Now, often caused by investors' attitude towards a security. So again, if they're feeling a little optimistic, we'll see higher yielding currencies catch a bid or start moving up in price. If investors are feeling more leery, a little bit more uncertainty, we'll see things like the dollar, the yen appreciate in value. Now, market sentiment is also important for contrarian investors. It's kind of the side that we like to take of the market. We like to kind of play against the retail investor. Now, the contrarian trades in the opposite direction of prevailing consensus. For example, if everyone's buying, a contrarian will be looking for opportunities to sell. Now, investors typically describe market sentiment as bearish or bullish. When bears are in control, stock prices go down. When bulls are in control, stock prices go up. Now, you guys may be saying to yourself, well, Nick, you're talking about stocks. I like to trade currencies. They're all related. They all have a interlink in a relationship. So great indicators that we're going to be using, or a great indicator would be price. We like to look at the stocks, look at some of these risk on currencies, and see the actual mood of the overall market. And this allows us to kind of make a decision and kind of be at an optimum place to make a trade or facilitate trade in a market. Let's go over here. So I'm going to look at risk off assets, golds and bonds. These are typically considered risk off. Now, in times of uncertainty, investors often flock to gold because it's a long history of as a stored value, especially one that is not bond to any government or currency. As a result, the increased demand for gold during troubled times gives investors a chance to make money during uncertain market conditions. As well as bonds, there's more than three, but the three main bonds. Now, U.S. Treasury securities or bonds are seen as the safest of all and virtually risk-free securities. They're issued by a handful of developed safe havens such as German bonds, the Japanese government bonds, U.S. bonds. Now, prices of Treasury securities often rise in value during times of market turmoil, resulting in higher demand as a flight to safety. Flight to safety, you guys hear me say that often. Investors pulling their money and looking for safer assets. So investors do look to make money in a crisis. The Japanese word for crisis is actually the same as opportunity. So when everyone's getting leery and nervous in the economic situation we're in, we're going to be looking for opportunities to make money. So let's get you guys some real world examples of market sentiment. Now, market sentiment turned bearish December 2018 when several factors worked together to unnerve investors. Firstly, the fears actually grew from sloping corporate earnings, so companies wasn't making as much money during this time. After several years of double-digit earnings growth from companies in the SP 500, many analysts predicted that 2019 earnings would increase, something similar to what we're seeing now. Now, the Federal Reserve Chair Jerome Powell stoked those fears at his monthly press conference when he said the central bank's balance sheet uh, runoff was on autopilot. The market viewed his comments as hawkish and not accommodative for a slowing economy, which further dampened market sentiment. Now, some of this may not touch bases yet, but in further lessons, we're going to dive a little bit deeper into what some of that means, as far as the Feds being hawkish or being dovish. Now, finally, unresolved tensions between China and the United States in a tick-for-tack tariff imposed by the world's two largest economies throughout 2018, as well as the government shutdown compounded with the issues above, severely damaged market sentiment over the month. So I always say you kind of can start seeing the forest over the trees, kind of read some of these signs, and can kind of get a general consensus of how price is going to move or be affected in a not a longer time approach, but you can kind of build your bias based on some of these factors. Now, bearish sentiment damaged investors' confidence. That caused the stock market to have the worst December performance since 1931. We had a big drop. We actually fell about 9.2% for the month. Let me check a few more of my notes here. The Dow Jones also did about an 8.7% drop in that month. So we see a textbook example of different elements coming together to cause risk off. Now here we do have a quick diagram or a visual of risk on, risk off. AUD, JPY, AUD being a higher yielding currency. As we go through this these lectures, you guys are going to get to the point to where we're no longer just looking at pairs. We want to kind of look at the said currency by itself and determine the strengths and weaknesses, or whether we're going to be coming into a risk on or a risk off mood from investors. So the first portion of this diagram, you guys can see risk off. See that AUD USD is dropping. Another great pair that we like to use is AUD JPY. And then we also see when investors are feeling more optimistic, we see AUD JPY or AUD USD start going bullish. Now, this is just touching the base level, giving you guys an introduction to risk on, risk off. In later sections of the fundamental aspects of the market, we're going to dive and see how we can actually use currency strength analysis and make trading decisions based off of this, and kind of see the imbalances in certain pairs and how everything should come back to an equilibrium. So we'll be diving into things like actual technical techniques, to where we may take some signals that we're getting from IDJPY and be able to apply it all the way over to things like Euro GBP. So very significant to start getting these bases. If you guys do, scroll back, rewind, shoot back through this, and jot down some notes on, risk on, what are the risk on currencies, what are the risk off currencies. So this is going to be risk on, identifying what is risk on, what is risk off. Just a quick little conversation about those two statuses in the market. Nicholas Cunty here again. If you guys click down below, you get to the next section, and we're going to dive a little bit more into intermarket, the economic scopes, and the things that actually drive the currency pairs.